I am joined by Bob Elliott and Andy Constan. Andy is of Damp Spring Advisors. Bob Elliott is of Unlimited Funds. Both of them used to know each other when they worked at Bridgewater, and they had an interesting exchange on Twitter about the soft landing, whether it's actually going to happen. So I'm so glad that we're here to get this. It's kind of a mock debate. We are here to talk about the soft landing, the no landing. Gentlemen, great to have you here. Welcome.
Hey, thanks, Jack.
Yeah, thanks for having us. It's exciting to do one of these with Andy.
Bob, you've been a proponent of the soft landing, a theory that was under some ridicule maybe 9 months ago. People were laughing at it. It's not possible we're going to have a hard landing. No one's laughing now. That seems to be the base case that is from many analysts, and so you've been proven right by the economic data. So a soft landing, my quick definition is one where the economy remains resilient, economic growth is robust as inflation falls. Why did you have a level of confidence that the soft landing was going to occur? And what have you made of the recent economic data that supports your view?
Cycles are typically quite slow moving, particularly I'd say traditional economic cycles. Most of us remember 2020 and 2008, and those cycles were acute crisis dynamics. But if you get away from acute crisis dynamics and look at more traditional cycles, even as recently as the 2000 cycle, it takes a while for these things to play out. And so we were having this combination of dynamics. Like, important to remember, a year ago, quantitative easing was happening and interest rates were at zero. So we're not that far into this cycle, particularly in the context of uniquely extreme monetary stimulation coming right into the tightening. And so for a while, basically, I was looking at the economy and saying, yes, there's been tightening. Yes, there's been a bit of moderation in the economy. But from an economic growth perspective, the economy, there's good reasons to think that it's going to be more resilient than you might initially assume, given the liquidity and the terming out of debt and the low interest rate sensitivity. And so we could have an economic expansion that kind of continues along. It isn't as interrupted, not immediately interrupted by the monetary stimulation. And then that was paired with, frankly, a period of time on the inflation side where we went from elevated inflation driven by supply chain shocks to a period where we got weaker inflation as those shocks got ameliorated. We're kind of transitioning through that. And so we had a period of time, which is what I'd call transitory Goldilocks, which is, growth was decent. It still is decent, and all the readings sort of point in that direction. And it looked like inflation was moderating for a while there, and did moderate from peak. But now the question is basically, are we going to continue this Goldilocks period, or are we transitioning to hotter than desirable on a forward-looking basis? And that's kind of where we're at in the cycle.
So there's the reasons for the soft landing. Andy, you wrote on Twitter that you think no soft landing, either a hard landing or higher for longer, followed by a hard landing. And then you say on Twitter, no chance that Bob thinks that an actual soft landing will occur. So what led you to say this? And when you say, Bob thinks there's no chance of a soft landing, what do you mean?
I think those are the likely paths, and a soft landing is always a possibility. They can happen. I think the odds of them happening are very low. And I think that, what Bob just described is, pretty much what I would think would be the expected path. I was a little bit more optimistic about inflation at reigniting due to for a couple of factors, and so was really residing on higher for longer island. But anytime you approach a landing when the economy is torrid nominal growth is turning into less hot but still warm nominal growth, the landing, the runway is in sight. The problem is once you and I think that's really what Bob was saying with the transitory Goldilocks. Before you land, there's a decision point that you have to make, which is, am I going to go for this landing or am I going to peel away? And stay higher for longer. But on the way, there's a fair likelihood that people think it's going to land softly. We can hope. Now, when I just look back at the last couple of months, my basic view has been all three are possibilities. Imminent recession is a possibility. A soft landing is a possibility, and a higher for longer is a possibility. And for me, over the course of the last few months, I would say my odds of higher for longer have shifted. Were always higher than the market and have shifted to, yeah, I think that's more likely than the other outcomes. But the one thing I was sure is I didn't know whether we were going to soft landing or hard landing or no landing. Um, but I was fairly confident and remained fairly confident that while the hard landing is one side of the coin, the higher for longer, followed by a hard landing, is the other side of the coin. Um, the edge of the coin, flipping the coin and having it land on its edge, is roughly what I think of for the soft landing. And I have lots of reasons for that, which we can go into.
It's really interesting. So, edge of the coin that doesn't happen if you flip a coin that much and it lands.
Fairly rare, yes.
Okay, so just for our audience, yeah, hard landing is growth and inflation falls sharply. Soft landing is inflation falls while growth, is robust.
I don't know about robust, by the way. I would
Yeah,
call
well, 2%, not real growth is not zero. It's not a recession.
Right.
And then higher for longer is where inflation reaccelerates and growth are very high as well. And I think the extreme version of the higher for longer situation, which Andy, you've been calling for a long time, higher for longer is now the term people throwing around is no landing, which I like a lot. So Bob, I think Andy's Andy's claim of how he sees your view is that you don't ultimately think a soft landing will happen. You have thought and have proven to be correct that the economic data and the price action in the short term confirms this transitory Goldilocks. But as the word transitory suggests, it is not going to be here forever. And a landing implies some sort of finality, as in this economic cycle will end and lead to a new cycle without there being a recession. So Andy's sort of claim, as he sees your views, is that you don't actually think a soft landing will occur at the end of this when the final chapter of this economic cycle. You don't think a soft landing will happen. Is that accurate as you see it?
Well, I think that the basic question that the Fed is facing is that inflation's too high relative to their target, right? And I think there was a period of time when we thought that what was driving that inflation was in fact transitory. It was something that, and I don't mean short-term transitory, which the Fed got wrong. I mean just like in general transitory over the course of a couple of years, and that it wouldn't seep into the rest of the economy, right? And basically through a combination of like the reality of the lead lags and cause effect relationships, plus the fact that the Fed frankly kept the foot on the gas for a little too long, meant that we have seen, like unambiguously, inflation has permeated a much broader set of the economy than just the areas, acutely affected by supply chain shocks. And that's basically what we're seeing is a bit of we had inflation that was too high and that was elevated because of supply chain shocks. And then we saw what looked like disinflation, a meaningful disinflation, but that was because a lot of the supply chain shocks were being resolved. And actually what we're getting, and we're sort of transitioning towards, is inflation coming back towards what is more the sort of underlying structural inflation. And that dynamic is an inflation that is elevated. It's not 8%, it's not 10%, it's not a disaster. It's just, 4-5-ish%, in that ballpark, in a way that is undesirable for the Fed to continue to have. And so when you have those circumstances, at some level, there's only one solution to that outcome, which is you have to have a substantial loosening of the labor market in order to get wage growth down, spending growth down, and the pressure on inflation to come down. And so that is essentially the hard landing that everyone expects. And so the question is basically, how much does the Fed have to do to eventually, I should say, I think we've answered the question, is inflation, is inflation in the economy broader than the supply chain shocks or not? That was an ambiguous question. I think we've pretty much answered that in my mind. And then the question becomes, how do we resolve that? And that's really the open question, which is how much tightening has to occur in order to get that done. And that's where that split of like, are we going higher for longer, or are we already there, is a real question. And certainly the data indicates that we need more rather than less. Certainly, if you look at the last couple of releases, it certainly looks like we need more rather than less in order to get to that point.
Okay, so Bob, you said a lot of very interesting things I want to get into. But I don't know if you provided an answer on when it's 2025 or 2026, and people in the markets, economists look back at 2023, at this current cycle. Will they say, oh yeah, we had a soft landing? Or will they say, yeah, we temporarily, it appeared that we had a little bit of a reacceleration in growth, but the hard landing happened, either because the hard landing happened or because the Fed had to raise higher. Sort of, yeah. What's your final view, taking out the time horizons? Which
there will be a hard landing, like that.
Okay.
Like there will be a recession, there will be a hard landing. The question is kind of when and how much does it take to get there. That's the real open question. And I think that question is I share Andy's thoughts on it, which is it's very uncertain about what the answer to that question is. And that's why, in a lot of ways right now, what we have to do is we have to like feel the data as it comes in, see, is it, are we turning? Are we not turning? Because, there's so much ambiguity having not been through a traditional cycle like this to understand all the sensitivities. It's been 23 years or something like that since we started off a cycle like this. And so we don't really know all those sensitivities. It looks like the economy can absorb more rates than certainly people expected at the beginning, right? But, we're still feeling it out day to day. And, we should be as data dependent or more data dependent than what the Fed is in terms of getting a sense as to what's actually happening. And has there been enough yet done?
Right. So now let's get into the economic data. Andy, what do you make of inflation where, I think year over year it was 6.5%, month over month is 0.5%, but then people strip out energy and housing. Then people, energy and food. Then people strip out housing. Then people say, oh, actually you should do it on a 3-month annualized basis. And there's so many different, whatever your conclusion is, you can find a data point that supports it. So what do you make of the, underlying nature of inflation in the economy, which is so relevant both to growth, but also the Federal Reserve's hiking path going forward?
So what I learned from the number on Tuesday was pretty much what I already expected, which is that, as Bob described the path of inflation, there remains structural reasons for inflation to remain well above target for a fairly long time. And to me, I'm looking at a combination of the strength in the labor market and the ample money and credit in the system, which has not been removed adequately, hardly at all, frankly, by quantitative tightening. And I look at that as the kindling that could be ignited at any point in time to fuel consumption or real or financial asset investment or real economy investment by the corporations that have saved all this money that came from the stimulus. And to me, unless the Fed reduces its balance sheet meaningfully and withdraws some of that savings from the money system, and wages and jobs weaken, and they're only going to weaken with stocks down a significant amount. Our ex-colleagues at Bridgewater described to lower the employment rate. Sorry, to increase the unemployment rate by 100 basis points, you need corporate profits to fall 10 to 20%, and they're not doing that. So there's still very ample reasons for demand-driven inflation. And that's the big picture. Now, what I would say is that a couple of weak prints associated with supply chain and energy in the the end of 2022, that was, I think, fairly expected, but I think people really overplayed that hand in terms of thinking inflation was over. And so now I think we're just back in the place where you have these, you know, enormous forces of very low unemployment and high liquidity um, that need to be removed for inflation to really come in.
Just so those forces of the labor market as well as ample liquidity. Want to get into those, but yeah, Bob, I want to give you a chance to share your thoughts on yesterday's inflation reading as well as the retail sales figure that came out today, which showed that for the month of January, on a seasonally adjusted basis, retail sales advanced 3%, which is huge. But as you write, the actual sales declined something like 18%, but that's just a lower decline than normal. So they seasonally adjust it and you get 3%. So I don't even know what to think of economic data anymore. Bob?
Well, I think that the most important thing when you're thinking about the macroeconomy is that outside of, let's call it, crisis type dynamics like '08 and 2020, the economy is like an enormous tanker ship, right? And to go faster or slower, it takes a long time. And you can almost think about the Fed like throwing an anchor off the back of that and slowly but surely hoping that it slows the tanker ship down. And so I think a lot of people on, particularly, in the media or financial Twitter and things like that, are trying to find the piece of information that shows that there's a big change. And the answer is, like, more likely than not, when you see outlier outcomes in the data, they're more likely false signals rather than good signals. And so I think you can look at it, and what I basically say is that the economy doesn't look like it slowed down nearly as much as would have been indicated if you had looked at the last couple months of data, whether it was retail sales or production or things like that. It also almost certainly didn't accelerate in January, the way that the employment report or retail sales look. And so, what does that add up to? Like, pretty much fine growth, like that, and not that much different than what I would have thought before those stats came out, which is like, fine. The growth is fine. It's not booming. It's not collapsing. It's fine. And it's fine enough to continue to keep keep the labor markets tight, continue to add enough jobs to keep labor markets tight in order to create that wage inflation, in order to create the income rising and the nominal spending that's outpacing, nominal or real production growth, real output growth. And that all adds up to structural, elevated inflation relative to target. And so, my main advice to folks would be to not read too much into any one data point and kind of, smooth through what look like relatively extreme measures.
Right. Yeah. So, Andy, one thing that I follow pretty closely is short-term rates as well as the Federal Reserve's terminal rate. So, how high does the market think that the Federal Reserve can get to? And that terminal rate peaked somewhere shortly after November, and that had been sort of been falling slowly as cuts were being priced into 2023 and 2024. As well as just they thought they couldn't get higher as inflation was coming down. And that coincided with the stock market rally. Did it cause a stock market rally? I don't know. However, that trade has now utterly reversed, where short-term rates have reaccelerated higher. The 2-year Treasury yield hit something like 4.7% I don't know if that's higher than it was in November. I should know that. The terminal rate itself is definitely higher, somewhere around over 5.3% as of today. So not just that it's at least two more hikes is coming. That's what the bond market is saying. Do you think the bond market has been pricing out a hard landing, which it was pricing in?
I've always been leaning that higher for longer is the better bet, followed by a recession, while recognizing that I could be wrong and that in fact the economy could, rapidly weaken, but again, not landing on its edge. Then there's the question of how the market's priced, and I think the market had priced um, different assets very differently. So, for instance, I had noticed a while back now that the SOFR spread, in particular, really the level of the 2024 DEES 2024 SOFR future, suggested significant cuts. In fact, I noticed it around 97.20, which implies a Fed funds rate of between two and three quarters and three in the first quarter of 25. And that was to me, thinking that we'd already have a terminal rate that was likely to rise. Um, a lot of cuts priced in. Even without a terminal rate rising, it was over 200 basis points of cuts being priced. And it's possible that the pricing of, and David Zervos wrote a nice note last week about the potentially bimodal nature of pricing, but in that 200 is really not 200, it's like 30, and 30 of cuts, or all the way to ZERP, to zero. And the probability weighted version of that is what really is priced. And I'm sympathetic with that idea. I don't think ZERP is in our near term future, regardless of any recession. Unless there is a financial stability question, and that's more of a question of the credit markets and the banks, which I think are in a completely different place than they were in 2008. So even still, I don't think ZERP is on the table in the deepest of deep recessions because of the potential and the reality of what we saw when the economy turned and the inflationary impact that had. I think the Fed will be very slow to get rates lower. So the long and short of it was, I think the short-term interest rate market had priced in extremely high odds of a recession, which I just didn't buy. So I shorted those um, during the Fed meeting at around that 97 plus level. Um, But also, what's interesting is the equity market is not pricing a recession at all.
Mm-mm.
At 4,100, using pretty much, you pick your model. I happen to use one that uses, sort of a very basic heuristic that that I demonstrate on Twitter a lot. But I have dozens of models. It's not really that important, the model. What's important is that interest rates matter to discounting future cash flows. And the higher they go, the worse it is for equities. And earnings do well when nominal growth is strong, and could do very well when wages underperform top line growth, something that Bob and I sort of nicknamed the sweet spot from last year. Um, And so I get the idea that equity, but still, when you add all those things up, 4,100 with the long bond yield, approaching 4%, generates most valuations, even in soft landing. So pick your earnings, but 4,100 to me, fair value, requires about 8 to 10% earnings growth in 2023. And that's not going to happen even in a soft landing scenario, which would show nominal inflation coming down, so less earnings boost. or even in a higher for longer, maybe you get that for in a higher for longer scenario, but then the discount rate is going to be crushing you. So that combination of things, plus what was priced in, certainly not a recession, a 25% decline in earnings is not priced in, at 4,100, but even the sort of soft landing case and higher for longer case, doesn't have a lot of upside to it for me. And so, the gimmicky trade was to be short twos and spoos. And what that really was a relative asset versus conditions trade, the odds of each of those various outcomes occurring, and expecting them to converge on one island or another. And we're still a long way from the fixed income market pricing in higher for longer. I sent a chart around recently. In fact, I just covered some of my SOFR Z's by buying SOFR U23s, which are through September of this year, because the entire move in twos, which has been a big move in twos, down. And thankfully, I've made some money.
Down in price, up in yield, yeah.
Down in price, up in yield, has been due to hikes in 2020, cuts in 2023 being priced out, and hikes in 2023 being priced in. So a higher terminal rate and fewer hikes. But 2024 really has had no impact at all. We're still priced 167 basis points of cuts in 2024. And that's still fairly recessionary. So the bond market is still pricing a recession, while the equity market is still pricing, and I think richly pricing, either a soft landing or a higher for longer. And so, that's what I try to do, not try to guess what island we're actually landing on, but try to see what the markets are pricing and then position myself to where those odds just don't align.
Right. So short twos and spoos, short the 2-year Treasury, and then short the S&P 500. So short stocks and bonds. The bonds, that has worked well this year. Shorting the stocks has not. Andy, do you think that would you say that the rally in stocks this year is unwarranted, given your analysis?
No, I think the transition from very significant negative outcomes for the bond market to neutral to higher for longer outcomes comes at the benefit of equities. Like if I was thinking of recession, my trade thinking of recession in early December when we started seeing that tax selling, and certainly by late December when the market was really down a lot, my trade would be short stocks and long bonds. Now that wasn't my trade, but that's what the recessionary trade was. And my gosh, you have to be unwinding that trade in 2023 so far based on the economic outcomes. So yeah, and while I think stocks are still rich associated with the other two scenarios pricing, those guys aren't selling because they're still in the game with decent equity performance. It's the short covering from the recession crew that are probably the principal drivers of what has been a modest rally in everything but the highest beta stuff like NASDAQ. The S&P is actually down from December 21st. Sorry, December 1st for 2 months now, or flat. But the rallies really happened in the most shorted stuff, the most tax selling related stuff, and the highest beta stuff. And that's pretty natural when you see funds flows from short equities to long equities that people grab beta.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and permissionless is something you might want to attend, what I'm saying is there's no time like the present, because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview.
Bob, it can be tough because as interest rates rise, future cash flows are worth less. So that's a drag on the valuation of equities, as Andy rightly points out. However, the circumstances under which yields rise often are ones that are reflationary, sometimes inflationary, but reflationary, where earnings should go up. So, I was actually surprised just looking back to 1981 that the stock market, the Volcker shock on the stock market wasn't as bad as I would have thought. Bob, what do you make of the recent stock market performance? How does your outlook on transitory Goldilocks shape your economic outlook on the short end of the yield curves, the longer end bonds, and as well as stocks? Andy said that he thinks that a lot of this is the stock market rally is short covering. How much short covering do you think it is versus real money buying? Investors actually saying, "Hey, I want to be long this market because I like what I see."
Yeah, I think when you looked at what was coming into the year, there was a lot of, frankly, like big bets on immediate recession in one form or another. And you can look at that a bunch of different ways. You could look at, like, the Bank of America Fund Manager survey showed basically all-time underweight stocks relative to all-time overweight bonds. You could look at, equity long short managers, gross or net positioning. All of those things indicated a very conservative and, frankly, recession oriented set of positioning coming in to the year, and that was totally wrong. Each day the folks who held those positions are getting pounded on those trades, and we're starting to get, particularly if you start to look at equity managers who came in underweight, like they're in the ballpark of career risk circumstances where they held big short tech positions and underweight stocks and things like that, and so they've got to quickly catch up to the beta. And that's basically, I think, in a bunch of different ways, what we're seeing is unwind of that dynamic. And I think it's important to recognize that the unwind of that dynamic is not necessarily sensitive to the precise equity market levels or what's priced into the levels, right? Those folks are not sitting there going carefully saying, well, I think the valuation isn't quite what it should be. They're getting caught on a bad trade, right? They were long bonds relative to stocks. They're getting caught. They're being squeezed. They're closing those positions. That's driving a move. I think it's important to recognize for those folks who are trading the markets that you have that can persist independent of the fundamentals, which I think Andy laid out very, very well. And if anything, what you should do is see that as an opportunity, because those are non-fundamental driven flows driving prices away from what should be fair value. And so when you come to that, that's a great opportunity. You always want to find instances where that's happening because it creates opportunities, assuming that you can, remain liquid and diversified and not get carried away in those positions. And so I think that's basically what's going on. On the margin, transitory Goldilocks, or Goldilocks in particular, is better for stocks fundamentally than it is for bonds. But the general idea of, stocks at 4,100 being more expensive today than they were, at the beginning of 2022, I think that's spot on. And it's a good reason why, going all in, YOLO stocks right now seems like an imprudent move. But there you got cross-cutting forces. I think the much more interesting and frankly, like, higher ratio trade in the market right now is those 24s cuts that seem, that are increasingly lower probability as we see the economy continue to chug along and generally get interest rates that are priced higher than they were before. And the fact that those haven't moved, the 24's cuts haven't really moved, means that really could, that's sort of leg two. Like leg one coming into the Fed meeting was frankly a pretty extreme expectation of Fed cuts in 23. That's mostly unwinded over that period. Now we turn to the 24's. That's where the opportunity is. And so opportunity to be short, to be clear. And so short price yield expected to go up. And so I think that's really the interesting thing. And then I'll toss in just an extra one, which is that, the Fed has transitioned from 50 to 25, or they say they've transitioned from 50 to 25. Right now, what's priced in the market for the possibility that they might go 50 in the next 3 meetings is essentially zero, very low in terms of the pricing there, that they could go 50. And look, like you get a couple of reasonably sized employment prints, inflation no longer is moderating in the way that they expected. The seasonal adjustment reset the level to a higher level than when they last made their decision. It's not clear to me that is going to play out that way. And so, this is maybe a little bit of a nuanced trade, but from a risk return perspective, the betting at least that 150 hits in the course of the next 3 meetings seems like a good risk return trade to me. And you're not paying that much for it.
Hey, Bob, I've got a question for this about this other trade I have. So in December 1st, I sold risk parity.
Yep.
So I was expecting tightening financial conditions. Not making a bet on bonds, stocks, gold. You know what risk parity is, but for the viewers, not making a bet on stocks, bonds, commodities, gold, anything. Just saying assets in general are going to see tighter financial conditions. And I was right for a month, and I've been wrong. Then was wrong in January, and now here I am, pretty much right, having been able to invest my cash that I got from selling all those assets at a nice yield, and I'm up a little bit of money. But the reason why I did that trade was the idea of that in either a higher for longer scenario or a recession, that both of those, a recession would cause tightening financial conditions as people earned less, lost their jobs, needed to repay debt. And in a higher for longer situation, while not necessarily rapidly, at some point, the central bank would have to engineer tighter financial conditions. I'm sort of torn about. I mean, the trade doesn't do much, but I'm sort of torn. What do you think overall, given that idea?
Well, I was certainly sympathetic to that general view, and frankly, I think in general have been surprised at how resilient financial asset prices have been relative to the magnitude of, what should be a relatively significant tightening based upon the combination of, duration issuance and the QT and the rise in interest rates and things like that. And I think that that speaks, what it does is it speaks to the overall environment where I think we don't really know how much of that essentially latent liquidity, which we know there's huge amounts of liquidity that was built up, right? That is certain in all sorts of different ways, in all sorts of different pockets and things like that. I think we're having a hard time, or at least I know I'm having a hard time knowing exactly what that balance is. Like, is QT of 90, 95 enough to start to turn the liquidity dial down? Or is it that we have to contract it at 150, right, in order to really start to bite down on liquidity? And so in that balance looks more resilient than I would have expected. And so, take that for what it is.
Yeah.
I think it's still an overall good trade, but we should also temper it with the fact, in terms of confidence, I think there's a lot of ambiguity about just how much liquidity conditions are actually gonna translate, and I think that uncertainty is that happens all the time, which is why, in the sense of like there's lots of times where you're uncertain about exactly what the sensitivities are and the betas and stuff like that, which is why you make a trade, but you don't go all in on one trade, because you can easily get that thing wrong. And I think the uncertainties are higher today than not. And so, basically finding a bunch of trades that are tilted in your favor is the way to go here. I mean, it's always the way to go, but I think it's particularly valuable here where your confidence in any one view is just like not that high. So like, could you be short SPOOs and twos and a diversified portfolio of RPAR or something like short RPAR, and then maybe
what's
looking for
Sorry.
RPAR of the ETF, which is just the risk parity ETF.
Oh yeah.
I talk in ETFs these days.
That's how you gotta do it. I mean, that's how the markets. You can't be you can't be talking about something that was important 20 years ago. Yeah.
Right, exactly. Well, I'm in the ETF business now, so I talk in ETF speak.
Right, but, Eurodollars, Eurodollars in a month or two, it will be we're living in a SOFR world. So Eurodollars
exactly,
as a contract will not be traded. Okay, so I just want to talk about financial conditions. Andy, you said you were short all assets, and by the way, Andy, when you say short all assets, did that include all commodities?
Well, it's risk parity. So it depends. Everybody has their own version of it. Bridgewater has their version of it. RPAR is similar, but has some inherent leverage and some rebalancing that is probably a bit more fast moving than other versions. AQR has a version. I have my own version. It just happens to. The goal is to be balanced for changes in growth and inflation, and be purely exposed to changes in financial conditions, or what normally is considered term premium or risk premium.
Right. Thanks for clarifying that. And so, you short all assets. It's not just stocks. So you said short all assets. That was your expression of the trade in that financial conditions would tighten. The only thing the Federal Reserve really controls is the level of risk-free interest rates. They also have a huge force of liquidity, which affects other financial conditions. But other financial conditions, as of a month ago, 2 months ago, defined it as the level of the stock market. How rich are stocks or cheaper stocks, corporate credit spreads, how much are you being paid above the risk-free rate? Is the dollar expensive relative to other currencies? That would tighten financial conditions. And a quote, objective measure of that, looking at the Chicago Fed or financial index or the Goldman Sachs financial index, they eased since mid-December as the stock market rose. Cuts were being priced into the back half of 23. Rates were going down, stock market up. It eased. I mean, you don't have to be a quant to tell that they eased. However, Jay Powell, and I really want to drive home this point because I'm pretty sure a journalist asked him about financial conditions. He could have acknowledged that they had eased over the past month, and to be honest, I expected him to do that. He did not. He said that they had tightened over the past year, which is accurate, but he did not address the easing in financial conditions, which I suppose, and I think the Federal Reserve supposes, impedes their ability to implement their 2% inflation mandate. So I think financial conditions is really important. So I just want to tie the knot between asset prices and financial conditions, and then liquidity. Both of you have talked a lot about liquidity, a concept that many people in finance, myself included, know, but it's very hard to actually understand what it means. So the Fed's balance sheet is rolling off a little bit less than $90 billion, $95 billion a month. Want to think that's a liquidity drain. However, there's all sorts of different factors with the Treasury general account being drawn down, the reverse repo facility being drained. So I suppose I'll start with you, Andy. How would you assess the current levels of liquidity, and is that higher or lower than you would suppose during a period of quantitative tightening, and why?
Right. So this is a very Bridgewater question. I'm glad we can hit on it. So there are many, many factors, but starting with the first thing you're saying, which is the financial conditions indexes as a measure. All the ones you described are circular in that they're asset price based. So when stocks go up, financial conditions ease. whenever the things that make the index move, financial conditions are perceived to have eased. But that's coincident. That's not a driver. Um, the Jay Powell's statement was, I think, very narrow and speaks to what he thinks is tight monetary conditions, which I do too, for that matter. And it's something I pay a lot of attention to. It is a market based rate, but what he was referring to was real interest rates across the curve are high and have stayed high even when other asset prices have rallied. So we haven't seen much falling of real interest rates during this period of time that he spoke about. So from that standpoint, from that narrow standpoint, financial conditions remain very tight. Now, the problem with the Fed, and this is where all these nuances come in, if you're measuring financial conditions by asset prices, and the Fed is managing the interest rate and having an impact on financial conditions by unwinding its holdings of Soma Holdings and having those people who need to pay the Fed back issue into the market. That's what they do. But there are a lot of other people. There's, for instance, I've noticed that in all of January, the indirect bids to the Treasury bond auctions were highest in history. What is an indirect bid?
And what does it mean?
An indirect bid is a bid that's submitted through a broker-dealer to the Treasury to do an auction. And the people who can't bid directly, even you and your mom and dad can buy treasuries through Treasury Direct. The people who can't tend to be foreigners. And so why were people in the rest of the world who hate the fact that we've weaponized our debt in the Russia battle through sanctions, why are they buying our treasuries? Well, you'd have to go a little bit farther and say what's happening in those countries. And so both Japan and China, and to another relevant party is the Swiss National Bank, those three guys, they're pretty much currency manipulators. They're not designated that way, but they play in the markets. And the way they play is when their currencies are very, very strong. We've seen the dollar very, very weak for all of the last, I'll call it 4 months. The central bank prints their local currency, sells it to somebody for dollars, and now has dollars. Dollars are not things you keep in your mattress. They're electronic dollars that have to be invested in something. And so what do? They show up at our auctions and they buy indirect. And that eases financial conditions because the guys who wanted to buy the treasuries, the non-central banks, the private sector, they can't get any. So they have to go out on the risk curve to get the assets they want, and that tends to push up other assets, including treasury assets. And so you have, measured by the FCI, which again is just coincident to these things, you have the markets rally. And so I thought that was an interesting factor. If you actually go through the flows, you'll see probably 2 months from now when the TIC reports come out of the Treasury that in fact China didn't buy any treasuries. And hey, Andy, that you thought they bought treasuries. Well, they don't want our treasuries. They've been letting them run off. So what do they do with the dollars? Well, what do they want? They've wanted gold and oil. And so while all these auctions were occurring, while the PBOC was trying to keep a cap on their currency from appreciating, they bought gold, they bought oil, and the sellers of gold and oil, maybe it's Saudi, maybe it's South Africa, maybe it's some people who just happen to have a lot of gold in their reserves. They sold the gold and oil, and now they have dollars, and they'll show up at our auction. And so, listen, that flow is hard to track, but I'm just describing the way foreign participants can muck up the liquidity that you might think is so linear by looking at the Federal Reserve. And then I'll say one last thing, which is the private sector can create liquidity whenever they want. If Jack Farley wants to go and buy some treasuries, he can go to the bank, say, hey, I want to do a secured loan buying some treasuries on leverage. And the bank will go out, purchase the treasuries for them, hold those treasuries as collateral, and lend them the money to do it right out of thin air. And so when does that happen? That happens when there's animal spirits. Was there animal spirits in the last in January? I think it'd be hard to think there wasn't. But the money could have come completely out of thin air. And so I think that's an important understanding. Also, short covering for people who are short is a repayment of those loans. And that's a liquidity injection. So the private sector liquidity, the foreign sector liquidity, and the Federal Reserve and Treasury are all pieces of this liquidity. And their conditions and their greed, animal spirits, fear drives flows.
So, Andy, in this circumstance where foreigners are bidding via indirect bids to the Treasury auction, are those incentivized to do so because of the fall in the dollar? You say when foreign currencies appreciate, they can, sort of game the system. Is that what you're referring to?
I'm saying there isn't. So this is an important thing that Bob mentioned, which is sometimes people do things for non-economic reasons. Mm-hmm. And central banks are a great example of that. And so if China wants to keep its currency from appreciating, it knows what to do. It sells its currency. So that's their goal. That's their only goal, was to sell the currency. Now they just happen to have dollars, and those are hot potatoes that need to be invested. And so they don't care what price they pay or what the yield is or anything. They just need to be invested. And so that those dollars flow into the world because China decided to sell yuan.
Right. And so you said something the beginning of your comment that Jay Powell referenced real interest rates, inflation-adjusted interest rates, which in the future are based on inflation assumptions, inflation break-evens, but you can compare spot CPI, what was CPI for January relative to federal funds. And I note that level is highly dependent on if inflation is rising or falling. In the Goldman Sachs Financial Conditions Index or all these reflexive models that you refer to, Andy, inflation is an indirect, it's kind of the puppet master because if inflation is high, the stocks will likely go down. However, it's not directly there, right? But when, I feel like this new financial conditions index that Powell referenced, and I saw Nick Timrose tweet, that Powell was using something that Brainerd said, that sort of alternative model, if inflation falls, financial conditions sort of must be, net easing.
So let me stop you there.
Yeah.
There's a lot of people that subtract the inflation print, and particularly, shockingly, the year-over-year inflation print from nominal interest rates to determine what real interest rates are. And that is utter nonsense and not what the Fed does. Don't ever do that. What the Fed does is look at the price of tips, and that's the real yield. They don't use that nonsense. They never have. Bob, do you agree?
I love Andy getting hot on how to think about real interest rates. I agree, and I would probably take it a step further, which is many people will, and I've seen this all over financial Twitter. They say, well, because inflation's coming down or has come down, and interest rates remain stable, that is an effective tightening. And I think it's really important to recognize that that is not necessarily an effective tightening. And the reason why that is because you have to think about who earns what money and who pays what debts associated with those two pieces to see whether or not it is actually an effective tightening or not. So for instance, from a household's perspective, right? If you think about that dynamic, if their wage growth remains constant and inflation goes down, that is stimulative to the economy, right? Very important to recognize. Falling inflation without falling wages is good for the economy because it stimulates, it supports real incomes, which supports real spending, right? Which is different from, say, a corporation who may be having a floater, although that's, that's less of a deal now, but it's still an issue. A corporation might sit there with a floater and they're essentially earning CPI, right? Because they get nominal revenues paying out nominal debt service, where the picture is a little different. But probably, most likely, the big picture story for the economy is that what would look like a rising real short rate right now, I think, is net stimulative to the economy. And that's pretty, that's a lot of people have that backwards out there. And I think it's actually a pretty important thing when we think about the durability of this rally, or the durability of the economy right now. Is, inflation has come down a lot. Like, gas prices or whatever have come down a lot. They were $5 to $3. Maybe they tick up or whatever. But like, when you look at that picture, like, households are actually in quite a bit better position today than they were a year ago when inflation was rising rapidly relative to their wages. Now we're seeing a transition to where their wage growth, which is sticky, right? Wage growth is a slow moving process. And inflation is still not at Fed target, but it's rising at a slower pace than it was before, which means that they have essentially more inflation adjusted, income in their pocket, which will support spending, which is lengthening the duration of this cycle. So, long story short, we've beaten the hell out of how to think about the real short rate, but that, I think, is both of those things are both what Andy said and this idea of what you earn versus what you pay and how you spend are important considerations when you're putting together the pieces of what's the interest rate, what's the inflation rate, and what's the likely impact of that on the real economy.
Right. Yeah. So, Andy, I agree with you. You're totally right. There's a duration mismatch, and I didn't know that. There's a duration mismatch between what was inflation over the past 12 months and what is the current rate now. 2-year TIPS yields went down from November to January.
It may or may not be restrictive. I'm not saying Powell's right to say the economy is in a restricted situation at this stage based on real rates. I'm saying that he's being very narrow when he talks about financial conditions. And that's not a problem. You just have to know what he's talking about, so you don't spend a lot of time yelling at the moon about how FCI has actually eased a lot. You could at least look at the thing he said. And I'm not making any more judgment than that. And also know that the FCI is not predictive. It is literally the market's price that drives it. Now, you can actually come up with some smart ways of determining whether financial conditions are likely to tighten or ease. It requires quite a bit of work, and I just gave you a couple of the places around the globe that you might want to think about in terms of what their influence on financial conditions are. People want to just look at it as some very linear formula of the Fed's balance sheet, and that's complete garbage. Now, it's one input,
Mm-hmm.
but it's not the picture. The picture requires a tremendous amount of work, and in particular, the way the private sector works.
Yeah,
Right.
and I think one of the things that I totally agree with you, Andy, that the financial conditions index is not there's nothing predictive for asset prices. It is essentially asset prices. The thing that it is predictive for is it's typically predictive for economic conditions. That's an important consideration, right? But economic conditions are not asset prices. And so I think what you see here is that those two things are different, because asset prices and asset returns are how economic conditions transpire relative to what's priced in, right? And so that is what you have to think about when you're trading financial assets. And so I think there is an important reality that those FCI measures are noting, which is that financial conditions were quite elevated. They were quite tight, 6 months ago. That created probably a bit of the economic slowing moderation that we saw. Now we've had economic conditions improve. We're likely to see a bit of economic acceleration, which we might be seeing a bit of the signs of, like not as extreme as what the data is suggesting because of the seasonality, but like the idea that we could have like a reasonably decent growth in Q1 and Q2, that makes sense to me as a function of the fact that the stock market's up 20%, and and that overall, and that interest rates are down relative to where they were at peak and things like that on the long end. Like that all makes sense to me, that mortgage rates are down and stuff like that. And so like those two things are just think about them differently. Like financial conditions are an input to macroeconomic and economic outcomes, which is, and future economic outcomes, which is an input to thinking about what's likely to transpire versus what's priced in. And that's kind of what that's the sequence of events, not the other way around.
Exactly.
I want to explore a possibility that the factors that are a drain on liquidity and therefore tightening financial conditions are here for a long time, whereas the easing of financial conditions that we've seen, Andy, the cross-border flows that you said, it's a little over my head, but that might be transitory, because the Bank of Japan rates are so low and the Fed is higher. That might not be here, but mortgage rates, they're not going back to 2%. The Fed's balance sheet is going to continue to decline. So, the spread between, mortgage-backed securities over Treasuries likely will stay high. It may decline, but it will stay high. Rates are going up, and rates will stay high. Andy, you made the point that I can buy Treasuries, but by borrowing money. But if I let's say was a hedge fund, I used to be able to borrow at 0. Now I can borrow at 4%, 4.5%. And I would be buying borrowing at 4.5% to buy securities that are yielding, 3.5% if I'm a 10-year Treasury. So is the nature of the bond market the fact that rates have gone up so high, and the fact that they're higher than forward rates in the future? So we had an inverted yield curve. Is that just kind of a systemic drag on liquidity that may outlast these temporary influxes of liquidity? Andy, let's start with you, and then Bob.
Sure. I mean, again, so complicated,
Yeah.
the broad picture of liquidity. I'll just talk about one thing I find interesting right now, which is the TGA spend down, which we know is going to go down because the Fed's going to run out of the government's going to exhaust its extraordinary measures soon, if they haven't already, and continue to issue duration, but really curtail bills until the debt ceiling is resolved. And that might be dramatic. But along the way they pay their bills is spending out of the Treasury General account, which, injects money without issuance into the financial system. So this is one of those things. Who gets the money and what do they do with it? So the first stop for the money is it gets deposited. And so banks have more deposits than they used to. Now they get reserves because of the circularity of the plumbing, which we won't go into, but they have deposits. And those deposits are in the name of their clients, but they can lever those deposits because they now have balance sheet capacity. So in addition, the depositor gets the money, and the depositor may withdraw it. Now, his withdrawal from a bank and then spending doesn't take the money out of the system. It is paid to somebody who puts it back into as a deposit. So the deposits just stay where they are, and that's sort of an injection. And if all those depositors decided to buy long-term treasuries, well, that would be stimulative, or SPOOs or meme stocks or whatever they decide to buy. Chances are, given who gets the money, which is, if you look at the U.S. Budget, most of the money goes to Medicare, Social Security, and other entitlements first, military salaries, and then ultimately some for interest broadly. But most of the money goes for what is really what it's needed for, which is immediate consumption. And then moves through the market, not touching any financial asset, stays as deposits, but the deposits shift from the people that got the money to the people that sell stuff, so corporations. And then ultimately, those corporations may invest in a broad asset portfolio. But that TGA spend down results in immediate leverable money by banks, so they could use it to finance assets, or um, ultimately any along the path ultimately to the end saver, but that's a long process. So now the reason I mention that is because of what you just said. Here I am, a bank, and I could give that money to the Fed, to back to the Fed, who will pay me IOER, which is interest on excess reserves. Yeah, I hate acronyms. That's actually a little bit, I think it's still a premium to Fed funds at the moment. It might not be, but it's very close to Fed funds. So a lot, 4.5, 4.75%. Or they can buy a 10-year bond at 3.5%. Why would they do that? Back in the day, when the yield curve was inverted, positively sloped, they could that IOER rate was zero. So why bother with that when I can buy duration that's paying me 2%? And that didn't require animal spirit so much. It was just, hey, that seems like easy money. What now is the case is that you really have to have an animal spirits view that you're going to get in asset appreciation in order to pay the negative carry that banks would have to pay. So I keep track of their ownership of securities. You have to do a lot of digging to find any understanding of their derivatives portfolio. But to understand what banks are doing with duration and their duration exposure can give you a sense on whether TGA spend down, that's right in front of us, a couple of months now, it'll be just spend down, will ultimately be stimulative to asset prices or not. And so my view is a lot less stimulative than normal because of the inverted yield curve.
Hey there, sorry to interrupt. A lot of forward guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some forward guidance listeners are into crypto. Some own crypto, a smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview.
What do you think, Bob? And then, you just have a comment that a potential bull case, the most bullish case for equities is, the fact that the government is running out of money.
Well, I think that I think that's I share Andy's view that looking at that one line is not a good reflection of overall liquidity, and that it's gotten a lot of tension because there's been like some relationship on a level basis, but when you do the real work to see whether it's even coincident or leading, it's not particularly compelling. I think the basic reason why that is because look, the big picture is that there's plenty of liquidity in the system and balance sheet. If you want to borrow to buy assets, you can, right? No one's running into any constraints anywhere. And that mostly to the extent that people are not buying assets or increasing their leverage, it's a function of their preference for assets relative to cash. And there's good reasons why you would think that you might want to hold more cash relative to assets. The sort of very direct pricing reason that Andy highlights is that the yield, an inverted yield curve for those who book their profit and losses, basically on a accrual basis is it's a bad deal on that basis. Um, uh, you know, and if you want to be buying, if you move from cash to assets, you have to believe that those assets are going to outperform cash at a time when there's already huge, essentially cuts priced into the bond market. And so, what I'd mostly say is, we have plenty of liquidity. I think that's actually an important consideration. And it's very different, very, very different from what we saw in 2008. In 2008, you have to understand that you could have been a bulletproof borrower and collateralized multiple times or whatever, and you still couldn't get the money. And so that's important dynamic, because it means that the pressure or any acute squeeze to start to sell assets or draw down, deleverage is not really there. So there's the ability to releverage. And so then the question is, given that ability basically fully to releverage, do you want to releverage? What do the asset prices look like relative to cash? How does that trade-off look? And how are you, how can you evolve that trade-off? And I think what you see is that, in general, sophisticated folks are looking at that trade-off and they're saying assets aren't a great deal. Cash looks pretty good. Cash is, yielding, providing a reasonable yield. And one of the important things to always remember about cash is that cash has unpriced option value, which rarely is discussed, but is critical to think about, because to the extent that you're in cash, you're not, you have the opportunity in the future to choose whatever assets you want. Of course, you forego appreciation, but I think there is like that choice value when there's high uncertainty that you might price even better than the yield that you're getting on cash. You're not paying for that choice value by cash having a low yield. And so you put that all together, and I think in general, people just, to the extent that assets are going down, or to be clear, to the extent that they're going up, it's because people want assets or don't want assets. And that's where you have to really get to the animal spirits, the fundamentals, looking at the pricing, looking at how people are understanding the real economy and the dynamics there relative to the pricing, in order to see whether or not these things are going to play out. Just that line on the chart, it's not going to help you.
Totally agree. Bob, earlier you referenced opportunities and trades. So I'd love for you to discuss, trades that look like attractive risk reward to you. I think you mentioned fading the rate cuts in 2024, which sounds like Andy is also eyeing. And so what you in particular think, as well as, I know that one or more of your ETFs tracks hedge fund strategies. What do you think are the good trades? And then what do the hedge funds think are the good trades?
Yeah, I think the biggest thing that that when we look at the hedge fund community right now that we see is that this is a time of high uncertainty, and in a time of high uncertainty, it pays to be conservative, and so I think the biggest overwhelming thing I'd say, both what I believe, but also when you look at these sophisticated asset managers, is that it's not a time to get over your skis on one particular path or the other. I like how Andy, frankly, has been navigating the last few months, saying, I don't know if it's going to be a hard landing. I don't know if it's going to be higher for longer. There's a lot of ambiguity there, but the odds of those two outcomes are being underpriced relative to the odds of soft landing, and let me make a bet in that direction. Both the two bets that kind of on the surface look like, why are you betting against yourself? But both have a positive expected value. And so finding a bunch of trades and not getting overweight on one outcome or another, I think is very important. So that's, when I think about the portfolio to build here, or what I'm seeing with the with the hedge fund community, is that they're very conservative in general in terms of their leverage, and then also not overweight one direction or the other. So a little bit of equity risk, a little bit of top of the stack credit risk, tilt towards value sectors relative to growth sectors, a little bit of bond risk because you could be wrong on that trade. And so you sort of put all that together. And what you see is a portfolio that is conservative, but positioned well for a variety of different outcomes, and certainly one that's not going to get hammered in many of those different outcomes. Now, what that portfolio has done is underperformed, high beta stocks, and that for 1 month or 6 weeks or something like that, it's true. But it's important not to get caught up in that when making a big bet on high beta stocks is really not. It's a very concentrated position, a very concentrated view on what's likely to transpire at a time when there's significant uncertainty.
So, Bob, my question for you would be, your thesis on the soft landing, as well as your highest conviction trade to express that view. But so that question I want to direct to Andy first.
My highest conviction of the things I have on?
Yes.
Gosh, I just put on some USD JPY at 130.82, which I'm really loving right now. And I think that actually has an unpriced higher for longer that is, that's playing out as the higher for longer thesis plays out. But that's what I'm loving right now. But twos and spoos is paying me. And I think it has a lot more to go if we start getting that back half of the twos spreads and the 2023 cuts start to come out. I actually still like the short asset portfolio, but it's very unlevered and sort of boring. So it's like cash, but even a little bit better than cash in my view.
Right, but so short twos and spoos is similar to short everything, right?
No, not really. Short twos and spoos is very focused on twos pricing in a recession and equities not.
Okay.
At price levels that I think can make money if we stay implying no landing is implying in the air. So this thing is lost it for me. While the outcome remains uncertain for which way the plane is going to go, I think twos and spoos can make money. Both can make money because they're both mispriced. Equities is a little rich, and twos and spoos and twos are a little rich. And so just holding those, I like, even if one of the outcomes doesn't show up. But I can't see a lot of downside if any of the outcomes show up. And so I really like that trade. That said, it has made a ton very quickly. So, I'm not taking profits on it, but for me to add more, I'd have to have it really come back in my face quite a bit.
Right. What about you, Bob? Highest conviction trades?
I think there's a lot of opportunity for those 24s to get priced out, those 24 cuts to get priced out in the market. And so that, that looks like the most interesting trade. But what I'd say is I'd say the biggest conviction is recognizing the uncertainty of the dynamics and trying, frankly, to put together a bunch of different trades that all kind of look in your favor. I like Andy's twos and spoos trade, but you'd want to pair that with other opportunities that maybe are a little. Make sure you're adding some other things like maybe commodities. They look a little cheap relative to industrial commodities, and oil looks a little cheap. I kind of like that paired with those other trades. Like you sort of put that all together. That's kind of you want to put yourself in a position. I also like stocks versus bonds while the Fed remains what appears to be a little bit behind the curve on that trade, long end bonds, not short end. And so you kind of, those are all kind of little trades that are kind of against the over tightening trade that I think are all pretty good trades and tilted in your favor. But recognizing that when I say that, what you're doing is you're betting a bunch of things, in any one particular path or one particular outcome. Not all of those will make money. But probabilistically, you'll make a little bit more on some relative to the others on the different paths that you're seeing. And so that is a highly diversified set of marginally beneficial positions is doesn't have the clickbait or excitement of going all in on recession or all in on the big flip or whatever that thing is, but is the right way to manage money. So
Yeah, let me say, my risk management system of never having any total portfolio that can cost more than 10% as a worst case drawdown, absolutely full stop, not with stops, but literally by structure, means that even while I am not particularly diversified, um, I have very little risk. And so what I'm trying to do is chop 10% a year with a 10% vol, generate a one Sharpe ratio in in a diversified, uncorrelated way to what I think the portfolio that most should have, which is a um, active long only portfolio that does some um, going to cash and some conservative reweightings to deal with the environment we're now in. And that's the way I manage money. But alpha is the one that seems to get the clicks. And so I'm only talking about 3 or 4 trades.
Right. Well, thank you both. You've been so generous with your time. I feel like I could definitely listen to this interview twice and learn a lot more. So people who are watching, the handles on screen at Bob E Unlimited and for you, Bob, and at Damn Spring for you, Andy. They are how you can find you guys on Twitter. My final question is, because this is a soft landing discussion, sounds like both of you agree that a hard landing on next 2 or 3 years is the most likely scenario. So Andy, your categorization that Bob doesn't believe in the soft landing or in the long term, I think Bob, perhaps you would agree or disagree, is accurate. But let's just contain this, because time horizons investing are incredibly important, to the end of the year, December 31st, 2023. How do you think you will characterize the economy and financial markets between now and then? Soft landing, higher for longer, no landing, hard landing. Andy, we'll start with you, and Bob, I'll give you the final word.
Still won't know. I don't know now. I still won't know. It'll still be the coin flip I described. I want to say that hard landing that you're talking about depends on no flinch. If we're right on higher for longer, we're not going to have a recession if he flinches and allows inflation to stay higher for longer. So don't count on it being anytime soon. It could be, but it depends on how policymakers act on whether it's late 23, early 24, mid 24, or maybe not at all for a while.
Thank you, Bob.
I think what I'd say is that it's likely to be more boring than the vast majority of people who are out there would like you to believe. The most likely outcome is kind of plodding along at moderate growth and higher than desirable inflation, and that slowly but surely the Fed responds to that, and we kind of look back at this year and see that it's kind of been boring, certainly relative to 22. That would be very normal. On the margin, my inclination is higher for longer, and eventually the Fed doing enough. But the allure of soft landing and the allure of pausing a recession, if it starts to emerge, as Andy notes, is there for every central banker. Go back and study Volcker and see how he did this, and he was captured by the allure of soft landing and supporting growth, even throughout being the greatest inflation fighter of history. And so odds are that's what it looks like, rather than any sort of big bang outcome one way or the other.
We'll leave it there. Bob, Andy, thanks so much. And thank you everyone for watching.
Thank you so much.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.